Welcome back to the e-commerce agency channel. My name is Camille Satar and I'm the owner and founder of e-commerce agency. Now, if you're somebody that's just started an e-commerce business using Shopify, you're probably thinking, how can I become tax efficient? What corporation should I be setting up? How should I be doing taxes? How should I be doing import taxes? Now, what I'm going to be doing today is I'm going to be interviewing an accountant called Steve from Alvery Accountancy, and he's been an e-commerce accountant for over 30 years. And I'm going to be asking him the most frequently asked questions about Shopify taxes. So don't worry if you're somebody panicking about taxes. I've got you guys covered in this video with an accountant that has over 30 years of experience. So make sure when you watch this video, you get your notepad and pen because you're going to learn a lot of stuff about accountancy and taxes with e-commerce.
Okay, well, I'm a chartered accountant of 35 years, and for the last 2 or 3 years, our specialism has been in e-commerce. We have 50% or more of our time is spent on e-commerce businesses, and we've got connections with lots of other accountants throughout the world to help us with the international business, and connections with other service providers that are relevant to e-commerce.
All right, perfect. So as everybody knows, we're definitely in a good place as Steve is a 30+ year experience chartered accountant, which is absolutely insane. So yeah, congratulations on that. So we'll get straight into the questions then. So what is the best business setup for taxation purposes, being sole trader, LTD, and all that kind of stuff?
Okay, well, a sole trader is without doubt more straightforward than a limited company, and many people will start off as a sole trader for exactly that reason, because at a low level there are no real benefits in terms of taxation to being to having a limited company, but once you could start getting into higher rates of tax, then it becomes more relevant to have a limited company. Okay, so what is by higher rate of tax? If you could give some numbers, that would be appreciated. Okay, in the UK, the higher rate of tax kicks in at 50,000. So net profit. Yes. Okay. So you're saying till you've done 50,000, then you should consider moving towards an LTD? Yes, you would consider moving towards an LTD. As a limited company, you have more control over your income. As a sole trader, if you earn more than 50k, then you will be taxed on what you earn. But if your company earns more than 50k and you retain those profits in the company to reinvest them in stock or marketing, whatever is necessary, then it's not your income because you've not taken it out of the company. So it will therefore be taxed at the company corporation tax rate, which is 19%. Okay. A limited company also gives you limited liability. Yeah, it's something that you definitely want in a business, just in case it's safe side. How in Shopify to correctly put tax and shipping tax into the system? You have to create your shipping zones in the shipping and delivery page, and then the destination countries will appear in the taxes page. So it's fairly straightforward. Within settings, there is a section where you load all your taxes. You just load the appropriate rate for each country. And if in the future you start selling into a new country, then that country will then appear on the taxes list, and you need to populate it as you go along. So Steve, when people are creating their tax shipping zones, where can they find the information from to actually know what numbers to be putting into these tax zones? They're fairly easy to find online, and you can just put them in. So it's as simple as going onto Google, Googling the country's tax, and then basically putting it into your tax zone, and then that's done.
What tax to apply if dropshipping from China going to all countries of the world?
A lot of drop shippers have relied for a long time on low value consignment relief, which means that coming into the UK, any goods with a value under £15, or into the EU, goods with a value of less than €22 have not been subject to VAT or duties. However, from 1st of January 2021 in the UK, that relief will be abolished, and in the EU, it will be abolished from the 1st of July 2021. So for those type of sellers, that's obviously not good news. As far as the rest of the world is concerned, the most obvious next destination would be the USA. And the complication with the USA is that every state has its own rules. A lot of those states have now implemented marketplace rules, which means that the marketplace itself, so if you drop ship through Amazon or eBay, then that takes away a lot of that problem for you, because the marketplace is actually accounting for that tax for you.
The next question I've got for you, Steve, is what do you have to look out for when selling worldwide?
Well, I guess we've almost touched on it just then, really. It's taxes in the main. If it's in the EU, it's VAT, and the equivalent outside of the EU is the goods and service tax, otherwise known as GST. As regards income and corporation taxes, there are double taxation treaties between many countries that prevent double taxation. Often the liability to tax will depend on having a physical presence in a country, and the liability will be in the country from where the business is managed. So generally speaking, you would only be liable to income tax or corporation tax in your home territory. When it comes to VAT in the EU, there are distance selling thresholds to be aware of, and that means that if you achieve a certain level of income by selling to consumers in any one country, then you will need to register for VAT in that country. You also need to register for VAT in any European country where you store inventory. So if you use Amazon FBA, for instance, any country where you use that, then there is no threshold. You would need a VAT registration in that country. Again, this is another thing that's going to change next year. From 1st of July 2021, the distance selling thresholds will be abolished, and any seller within the EU selling to other countries within the EU would be required to account for VAT at the rate applicable where their customer is. Now, that doesn't mean that everybody's going to have to register for VAT in lots of countries where currently they don't have to. What it means is that there will be a system which will be known as the one-stop shop, whereby on one return submitted in your own country, you put all your income and VAT that's relevant to all the countries that you sell to, and then your country, in the case of someone in the UK would then pass that VAT on to the other European countries that it belongs to. So whilst the abolition of distance selling thresholds might sound like a bad thing, for those that are already over those thresholds and have VAT registrations in the EU, it's actually a good thing, because they won't need to be registered for VAT in some of the countries that they are currently registered in, and they can just do one return to the UK that deals with everything. For those that aren't registered in the EU currently because they are under the VAT threshold, then if they are UK VAT registered, they would be paying UK VAT anyway. So it's an added complication, because you'll now need to differentiate your sales between all the different EU countries and the relevant rates, but that's not too hard.
Okay, perfect, Steve. So the next question I've got for you is, how do I calculate the percentage I should save from each sale?
There's definitely no one percentage that you can apply to all businesses, and of course you've got potentially more than one tax that you need to put aside for, because you might be putting aside for VAT. If you're a company, you'll be putting aside for corporation tax, and if you're a sole trader, you'll be putting aside for income tax. The amount of VAT that you need to put aside, although we know that VAT is 20%, but of course you offset VAT on your costs before you pay that over to HMRC, and every business is going to be different in terms of the amount of costs that they have to reduce their VAT liability. Cost of sales, the product that you sell will be the biggest cost on which you're reclaiming. But if you purchase your goods from, say, outside the UK but within the EU, then you won't be paying any VAT on your cost of sales, so therefore you won't have so much to reclaim. Whereas if you purchase your goods within the UK, then you'll have more to reclaim. Equally, if you purchase them outside the EU, you'll pay VAT on import and you'll have more to reclaim. And then you've got your overheads, some of which will have VAT on and some won't. So you really need to work that one out on a case-by-case basis. And for corporation tax and income tax, that's based on profit, so not on sales. So again, you need to monitor your bottom line and put aside on that basis. If it's corporation tax, 19%. If it's income tax, 20%. But then you've also got national insurance at 9%. And then, of course, as we mentioned earlier, we've got higher rates of income tax over 50,000. Becomes 40%, and the national insurance rate reduces down from 9 till 2. If you're a company, well, we haven't really touched yet. We'll get to that later. I think we'll talk about remuneration and strategies from a company. But if you're a company, in addition to your corporation tax, you will also have a personal tax liability on your dividends.
The next one is, how does VAT and GST work? When do I charge my customers those taxes?
Okay, so VAT, in the UK, you need to register for VAT when your income reaches 85,000 on a rolling annual basis. So as soon as you're registered, you will be required to charge your customers VAT. But as we mentioned earlier, you can reclaim VAT on your costs and offset this against the VAT collected from your customers before you pay that to HMRC.
Okay, Steve, for those who don't know what VAT is, what does VAT stand for?
Value-added tax. So there is a simplification scheme, which is known as the flat rate scheme. Mm-hmm. And if you use that, well, first of all, it's available to businesses with a turnover of less than 150,000 a year. And if you use that, you don't reclaim any VAT on your costs, which is where the simplification comes in. But what you actually pay to HMRC is a percentage of your income. So it's just a flat percentage. And that percentage is determined by the sector you're in. And so for most e-commerce businesses, they would fall under general retail, and the percentage for that is 7.5%. So for every £1,000 worth of sales, you would pay £75 of VAT to HMRC. Whereas, of course, if you were just using normal VAT accounting, it would be more than that, but you would reclaim the VAT on your costs. It's possible that flat rate will give you a higher liability than it might do on the standard scheme. Equally, it could be less. And you need to work that out before you decide which one is best for you.
Okay, perfect. What about GST then?
GST. Well, yes, so GST, General Goods and Service Tax, is what's used by most countries outside of the EU. It's generally speaking, it's a flat rate, and there's no system of reclaiming GST on your costs. You just simply pay the rate that is applicable to your product in the country that you're selling to the revenue authority.
How do I handle taxes if I'm dropshipping in the US but live in another country?
In order to be liable for GST in the USA, you have to have what they call a tax nexus. And that used to mean, by and large, that you needed a physical presence. But the Wayfair case, which is a very famous case that anybody who knows anything about GST will be familiar with, that changed all that. And most states now have their own rules, have additional criteria in terms of economic nexus that require you to register if your sales reach a certain threshold. So that's very similar to the way that the VAT works in the EU. But typically these thresholds are $100,000 in a single state. So you need to be doing quite a bit of business in the states to have to be concerned about that. But there are also, most states do have thresholds that are based on number of transactions as well. Some as low as 200. So that could mean an earlier registration point for a lot of businesses. Most of the states now, however, have marketplace rules, which I think we mentioned earlier, which require the marketplace to account for the GST on your behalf. And a lot of Amazon and eBay sellers will already have seen that they are having tax deducted within their payouts. So there are many, because each state sets its own rules. There's lots of different scenarios, and ship supplier might be actually located in the states and might have nexus in some states and not others. But equally, neither you nor your supplier might have nexus, in which case the sale would actually then be liable to consumer tax, which is something the consumer themselves is responsible for. As you can imagine, with the consumer being responsible for accounting for their own consumer tax, it's not very well enforced, and it's quite difficult to do so. Hence, the move towards marketplace rules that require the marketplaces to account for that tax for you. Because every state does have its own rules, and they're constantly evolving and changing. We always advise to get local advice, and we have contacts in the states that can provide that service.
Perfect. So the next question I've got for you is how to get tax and Shopify invoices automatically in your own accountancy software.
A number of ways you can do this, and obviously it depends on your accountancy software. We use Xero, and that integrates with Shopify. So once you've integrated, Shopify will send details of the invoices to Xero, and it will also create a transaction in Xero for Shopify's fees. However, of course, as we all know, one of the big problems with accounting for e-commerce transactions is that a payout it comprises not just your income but also fees, and you need to split that out. And when you reconcile those invoices that Shopify creates to the payout, you will need to know sales are within that payout so that you can reconcile them against that payout, which is quite easy to do because within Shopify, it will tell you exactly what sales are within any one payout. But if your volumes are significant, that becomes a very long and tedious job. And that's when you probably start looking at alternative ways of doing it. And there's products like A2X, for instance, that will sit between Shopify and Xero, and it will gather the actual payout data. Effectively, rather than letting Shopify create hundreds of invoices for all your sales on one day, it will consolidate all that information into one invoice with all the correct VAT treatments that will then reconcile to the payout that's received into the bank.
That is such an easier way of doing it. I hate going through all the reconciles, having to make sure they're all right and matched. It takes forever. So that's definitely a great tool to use once you get down a high volume part of your journey. So what are some good ways to keep track of expenses then?
We tend to use Xero accounting software for, well, not just tracking expenses, but also tracking income. It has lots of integrations, like with Shopify and A2X integrates with a lot of other platforms as well. It will also integrate with your bank account, so all the bank transactions will flow into Xero, and it's very easy to reconcile. You can create rules to make that process easier.
And then Xero starts doing smart learning, where it will automatically detect which each one is, and then
yes, it does as well. Yes, it does that. Yeah.
Really good.
Just need to make sure it's guessing correctly though.
Yeah, there's been times where it gets one right, but then it gets two wrong, and then it
it is.
The algorithm needs to get a little bit better. What parts of e-commerce are tax deductible expense write-offs? For example, marketing, transaction fees, and cost of goods, stuff like that, basically.
Yes, well, all those things that you mentioned would be deductible against tax, and the general rule is that the expense should be wholly and exclusively for the purpose of the business. So common sense actually goes a long way in that respect. So obviously your selling fees are going to be allowable, shipping costs, payment of gateway fees, translation services, for instance, if you're having to get your website translated into different languages, your warehousing costs, packaging, all your overheads, fulfillment costs.
So let's say I need a video. Let's say I need a video making for my product, or hire a photographer to shoot that video for my product. Would you say that?
Yes, absolutely.
Mm-hmm. So it's really anything that the business pays for to keep operations going in terms of growth. So I always say to people things like transaction fees, things like email marketing, software, all that kind of stuff is great. And again, you can find a list of all of these things online for your state, for your country as well, which is also When should I pay annually or quarterly? Does it make a difference?
Okay, well, that depends on which tax we're talking about, of course. In the UK, VAT is payable quarterly, although larger retailers do have to pay monthly. In a lot of within the EU, Germany, for instance, is monthly. You don't have a choice. But some other countries are also quarterly, and again, in the States, it varies from state to state. Some are monthly, some are quarterly. An annual scheme in the UK for VAT, I don't tend to like it myself. You still have to pay every quarter based on estimates. And you just submit one VAT return at the end of the year. Of course, you've got your income tax, and the tax year ends on the 5th of April, and a self-assessment tax return is due by the 31st of January the following year. The thing to watch out with there is that if you owe more than £1,000, then HMRC put you onto instalments. So in year one, if you owed more than let's say you owed exactly £1,000, then on the following 31st of January, in addition to paying that £1,000, HMRC would require a 50% instalment against year two. So you'd actually pay £1,500 at that point in time. The other 50% is then taken on the 31st of July. So you almost pay 2 years' worth in the space of 6 months. But then you come the following 31st of January, you've already paid for year two. So you would only be paying a 50% instalment against year three.
Okay, cool.
So you have that initial kind of big hit, but then it evens out over years 2 and 3 and going forwards.
Okay. And with paying tax, let's say paying VAT quarterly, does that mean you get your VAT back from what you've paid VAT on every quarter as well?
Yes, it does. Yes, because you set off the two against each other and just pay the net amount.
What are the best methods to avoid tax? Let's hope HMRC are not listening to this.
Well, that obviously, that depends on whether you have a limited company or you're a sole trader.
Okay, so to answer this, what is the what is the better option to cut tax down, having a LTD or having a sole trader? Which one's more tax efficient in terms of getting things done?
For the higher income earners, it's definitely a limited company because, as we mentioned before, you have more control over your income. If you are a limited company, then you need a tax efficient remuneration strategy, and that generally involves paying yourself a small salary at the national insurance threshold, and then anything above that is payable as a dividend.
Cool.
If you're a sole trader, then you have, if your income is less than 150,000, you have the option to use the cash basis, which means that if you bought stock before the end of the year that you hadn't sold, then that would be tax deductible in that year, whereas in a limited company, it wouldn't be until you actually sold that stock. You wouldn't deduct it against your profits until you actually sold it. Obviously, that has implications for cash flow. If you at that point in time decide you want to buy some additional stock, also increases the risk of obsolescence. So it's not something you need to think through before you do it. Good way of reducing your tax bill, if it's something that appeals to you, is an electric car, because if you buy one, it's fully tax deductible, and at the moment the benefit in kind, which is the tax that you would pay on the personal use of that vehicle, this is if you're a limited company, is actually zero, or it does increase to 1% next year and 2% the following year, and I'm sure it will go up again.
So if you buy an electric Tesla this year, this year of the tax,
yep,
you will get a full tax deductible on that vehicle.
Yes.
Now, the government love electric cars because they're even willing to give you grants for them, right?
Yep. Yes.
How does dividends work? Can you pay yourself dividends if the company's made no profit?
No, in a word.
So talk a little bit about how dividends works and kind of how accountants use it.
Dividends are not tax deductible in the actual in the company itself because they are paid from the post-tax profits of the company, but they are then taxable on the individual recipient at 7.5% basic rate and 32.5% higher rate. There is also an annual £2,000 dividend allowance. So if assuming you've got no other income from other sources and use the standard income strategy for withdrawing your cash from your business, you'd pay yourself a salary. Let's call it 8,000 to keep it nice and round. The personal allowance this year is 12.5, so you'd have another 4,500 of dividends that are tax-free. You've got another 2,000 dividend allowance, and then thereafter, those dividends are taxed at 7.5% until you reach total income of 50,000.
And how often can you do dividends payouts?
You can have a dividend as often as you like. The only criteria, which you mentioned right at the beginning, is that you need to have some profits.
Can you pay yourself a dividend if you're not a limited company? No,
dividends are paid by companies to shareholders.
Okay, perfect.
So they don't come into play for a sole trader.
What makes a good e-commerce / dropshipping accountant? So now people have watched this, they're probably thinking, well, it doesn't make any sense to me. I don't understand this. It's a different type of language. If I'm looking for a accountant, what would make them liable and credible to use? What would you say after your 30 years?
Well, I would say that you need to be familiar with all the different platforms and marketplaces and how to effectively integrate them with your accounting system. You need good knowledge of VAT and GST on a worldwide basis. And I think it also helps to have a good network of partnerships to support an e-commerce business. For instance, we have partnerships with companies that provide legal services, specialist insurance for e-commerce businesses, artificial intelligence for personalised shopping experiences, order management and inventory systems. The whole range of services is there. And I think it's also really good and useful if an accountant can provide a forum for clients and other sellers to ask questions. So, and with that in mind, we created a Facebook page called E-commerce Business Builders UK. So anybody can join that group and ask whatever question they would like.
So basically, Steve's got a Facebook group where you can join it and you can ask your questions regarding e-commerce tax, and you can get some questions answered in there. So you're saying that accountants that are willing to offer that extra free help are ones that tend to be quite good. And you're also saying accountants that have a lot of networks to different people in different industries, different countries. So the more network they've got in higher places is also a very good thing to look for. You don't want to go to an accountant that's just them and just them only. You want to make sure that they've got other people in mind as well.
Yes. There's quite a few that also seem to specialise to Amazon sellers, which is great if you only want to be an Amazon seller, but not so good if you want to become an omni-channel business.
Okay, so how much are people looking to pay for an accountant every year? And do you pay an accountant yearly or do you pay them monthly? How does the payment structure for an accountant typically look like? And what are the prices people can look at when getting one?
Most accountants probably now charge a monthly fee. Our fees are on our website and they start at £120 per month for our premium package, and that's for a limited company. That includes everything that you would need except for the bookkeeping, because you can't put together a pre-packaged product for bookkeeping services, because that depends on so much on the business and how many channels and platforms and revenue streams that you have, how large the business is. And you may also need additional software to integrate your platform or marketplaces to the accounting system as well. So the packages move up after that, and the main differences between those two are the provision of more detailed analysis and management accounts on a quarterly or monthly basis.
So you're saying that accountants typically charge you on a monthly basis, and again, these fees that accountants charge you are classed as legal fees, and I'm guessing they're tax deductible as well.
Yes, they would be.
So, Steve, if somebody watching this today from the UK is looking for an accountant, where can they find you?
www.elverycommerceaccountants.co.uk.
Perfect. So thank you very much, Steve, today for answering those most frequently asked questions that I get a lot of. And I'm sure a lot of people that are watching this today now will have an insight of how things look like and what they should really be focusing on. And they now know how to get an accountant and what to look for as well.
Right. Thanks very much for having me.
No worries, it was a pleasure. So that's the end of the interview with me and Steve from Elvery Accountancy. Now, if you're somebody from the UK looking for an e-commerce accountant, I will leave Steve's accountancy firm in the description. And if you've taken value from today's interview, make sure you smash the like button and you let me know in the comment section below. And I'll catch you guys on the next e-commerce agency video.